Good morning.
Morning.
Whew. So how you doing this morning? Enoch, Haley, Mandy?
I'm good. How are you?
Surviving. Have any of you had a chance to look at the voiced over PowerPoints that were posted?
Yes.
Okay.
Yes.
Does it look like they may help?
Yes. Let me see.
That's okay if it doesn't. That's all right. It's just another resource.
It does. I have a problem with the.
Enoch, your voice, your audio trailed off. Don't worry about it. John Kamari Hutch, good morning.
Okay. I've got a problem with chapter 3, slide 6.
Ah. I put this thing where it's, I'm looking up. It's too close. I want it further off so I don't look so bad. All right, guys, I've got 10 o'clock. I think I'll go ahead and start. I did post some voiced over PowerPoints I had made in the past for a more advanced class. I trimmed it down to fit this class. The reason I posted those, I was in a lot better voice when I made those. So I'm sure easier to understand than now. All right. We're about to embark on chapter 10, the cost of capital. The remaining 3 chapters that we have. In fact, I'll go to a graphic to make that point. We've got 3 chapters left. Come on. Um, sorry. Chapter 10, which we'll get in today. That's cost of capital. Chapter 11 deals with capital budgeting techniques. Or as the author calls it, the basics of capital budgeting. And then chapter 12 actually deals with capital budgeting cash flows. Okay. Companies follow a maturity matching concept. And as you'll learn in a minute, by definition, capital refers to long-term sources of funding. Nissan, when it built that plant up in north of Jackson, what is that town? Guys, I'm drawing a blank. The Nissan plant is in Professor Cudd calling then 341 class come in. Haley, I bet you know, what's the name of that town? It's not Madison, it's north of
I'm
there.
not sure.
Really?
I'm not sure.
Okay, well, anyway, all right, never mind. Nissan built a huge auto manufacturing plant. But before they built it, they had to decide if it's a good idea. So they went through an analysis process to see if it's a good idea. And basically what they did is what we're doing with these three chapters. They go together as a package. These three chapters are how companies evaluate big, long-term projects. Like a plant. The cost of capital, which is what we start with, is how we determine the minimum rate of return we need on that investment. Capital budgeting cash flows is how we forecast the cash flows for the plant. And then once we have the required rate of return and the project cash flows, oddly, the last thing we do is apply our techniques. However, your author and other authors cover these chapters in this order, so I will too. But the bottom line is we combine what we learn in these three chapters together to simply get a thumbs up or a thumbs down on a big project idea. Obviously, Nissan went through this and ended up with a thumbs up because they went ahead and built the plant. Had they gone through these three chapters, these three approaches, and decided it was a bad idea, they wouldn't build the plant. But the whole purpose of these three chapters together is to decide if the project is a good idea or bad idea. So, starting with chapter 10, it's called a cost of capital. By definition, capital refers to long-term sources of funding. This would primarily be long-term debt, preferred stock for the few companies that sell preferred, and then under the category of common equity, we would have retained earnings, and the sale of new common stock shares. If you'll notice, not in capital is current liabilities. Why? By definition, capital refers to long-term sources. Current liabilities are the short-term sources, so we don't include them in capital. Now, most companies sell long-term debt and use retained profit. You know, they make a profit, they may or may not pay some of it out in dividends, but they hang on to the rest. They retain the rest. These are the two major sources that most companies use. Preferred stock is really only used by regulated monopolies like Western Gas, Energy, Con Edison. And companies, for reasons you'll see later, hate to sell new shares of common stock. So although in theory there are 4 sources of capital, most companies only use 2 of these. Now, so retained earnings and long-term debt are the 2 primary sources that most companies use. The cost of capital, the WACC, remember from the last chapter, the WACC represents, that acronym represents weighted average cost of capital. Companies will get their money from multiple sources, like long-term debt and retained earnings. And the weights will reflect how much they're getting from each source. But when we speak of opportunity, when we speak of cost of capital, we're really referring to the opportunity cost of capital. What the company thinks it should earn, what it thinks it could have earned using the money other ways. Now, a new factory, a project, will be funded by a mix of debt and equity. And on the funding for the project, the company has to earn enough to pay the interest expense on the debt, and to provide a return on equity that keeps the stockholders happy. The term for the minimum rate of return that needs to be earned on a project for it to be acceptable, that's what we call the WACC, the weighted average cost of capital. There are many ways to look at it, but the WACC is the minimum rate of return we need to earn on a project to justify accepting it. If you want to, think of this as a hurdle rate. For example, if the cost of capital were 12%, then when we look at a project's expected rate of return, it would have to beat 12% to be considered an acceptable project. So if the WACC were 12, and on a project we expect, well, I don't know, 11, we'd reject it. It's not good enough. If we have a project where we expect 15, then we would accept it. We require at least 12, so 15 would beat that. So think of the WACC as a hurdle rate, minimum required rate of return. Now, in formula form, that's the full weighted average cost of capital. It's the weight for debt times the after-tax required rate of return on debt. We also call that the component cost of debt, plus the weight for preferred times the component cost of preferred, plus the weight for equity times the component cost of equity. The weights represent how much of our money we get from each source. The R sub I, the R sub P, the R sub S, those represent the required rate of return on each source. For example, just for a second to deviate, here's your weighted average cost of capital. The weight for debt times the after-tax cost of debt plus the weight for preferred times the after-tax cost of preferred plus the weight for equity times the after-tax cost of equity. What if our company had the following capital structure? If I could spell. Let's say it's, I don't know, 40% debt, 10% preferred, and 50% equity, common equity. Also, let's assume that the component costs of each are as follows. On debt, we've determined we need, on the debt money, we need to earn 5%. On the preferred money, we need to earn a 10% return. And on the common equity, we need to earn 20. So our WACC would be the weight for debt, which is 40%, times the 5% we need to earn on debt, plus the weight for preferred, which is 10%, times the 10% return we need to earn on preferred, plus the weight for equity, which is half, times the required rate of return on our equity funds. And if we crank that out, golly, I did that in my head. Does that look right? I think so. So what is that? That's the minimum required rate of return for a project to be accepted. It is a weighted average of the different component costs. Component cost of debt, preferred, and equity. Straightforward, weighted average. You get so much money from one source where you need to earn a certain return, so much from another. You take a weighted average. Now, again, what if we had a project proposal? Project X and Y. The expected return on X is 10%. The expected return on Y is 15. What would be our decision? What would our decision be on X? If we require at least 13 and we only expect 10, we would basically say X is not good enough and reject it. If we have a required rate of return of 13 and a Y expect 15%, then Y is good enough and we accept project Y. It really is so straightforward, it's tricky because it is just simply straightforward. Okay, see how this works. Why do we call it weighted? Because we get a certain amount of money from each source. You know, in my example, 40% from debt, 50% from common equity. Why do we call it cost? It's really an opportunity cost. Or as your author likes to refer to these, component costs. Each source of funding has its own required rate of return, its own component cost. On the money you raise from debt, you need to earn enough to cover the interest expense on debt. On the money you get from retained earnings, you need to earn a return high enough to keep the shareholders happy, because technically retained earnings belongs to the shareholders. Two basic steps, like a Texas two-step. First, you calculate the component costs of each source of funding. that is the required rate of return on debt, the required rate of return on equity, then you take a weighted average. Very straightforward. The math in this chapter is not only straightforward, the concepts you've already seen. So, best way to get your feet wet is just look at a project. Let's say Ultra is considering a new project proposal, a new factory. Someone has said, let's build a new factory. So now we've got to decide if it's a good idea or not. Ultra, like most companies, will only use long-term debt and retain earnings to finance the factory. And by the way, retained earnings is not the retained earnings account on the balance sheet. This is really just a portion of current profits the company hangs on to. So if the company makes profit this year of 100 mil, pays out 40 in dividends and hangs on to 60 mil, retained earnings is 60 mil. That's what they've got in cash from current profits that they hang on to. Now, most companies don't use preferred stock. Regulated monopolies, whoa. Why does it do that sometimes? Okay, fine. Regulated monopolies are the only companies that use preferred stock. They have sort of a market niche cut out. And it's easier at this point not to try to figure out why, just note. Companies like Western Gas, Energy, Con Edison Electric, all the regulated monopolies, your electric companies, your gas companies, they're the only ones that tend to use preferred stock financing. Normal companies like Microsoft, GE, they don't use preferred. And companies don't like to sell new shares of common stock. Actually, let me explain why. Why don't they like to sell new shares? Number one, new shares carry high flotation costs. When companies sell new shares of anything, they use investment bankers. Investment bankers charge a fee. The riskier the security, the more they charge in flotation costs. And stock is riskier than debt. So if a company decides to sell new shares of common stock, they incur high flotation costs. Another negative about doing this, the new shares carry votes which might create a control problem for the company. Those with the most votes control the company. So if a company sells new shares of stock, there are more votes going out there that can get into the hands of people they don't want to have control. But most of all, The reason companies don't like to sell common stock has to do with something called asymmetric information. You know what the English translation of that is? Management knows things about the company's outlook that the market doesn't know. Inside information. So investors like me or you, we're constantly looking for signals. I guess a poker player would call it a tell. But we're looking at hints as to what management is thinking. And here is the situation. When would management probably want to sell more shares of stock? When it thinks the shares are overvalued or undervalued? It'd want to sell more shares of stock when it thinks the shares are overvalued. So what happens when a company tries to sell new shares of stock? Investors like you and me say they wouldn't want to be selling those shares unless they thought the price was too high. So it sends a negative signal to the market. The mere act of selling shares suggests management thinks the shares are overpriced. And of course, that's a negative signal. If management decides to sell more shares, investors, because they know management knows things they don't, investors will say, gee, management must think the shares are priced too high. And then what happens? That drives the price back down, which works against the better interest of the shareholders. So, as odd as it may seem, most companies do not like, they don't like to sell preferred and they don't like to sell new common stock. What does that leave? That leaves long-term debt and retained earnings. Now, your author is going to suggest that some companies even use notes payable as capital. But that's a short-term source, so we're going to stay away from that. We're going to assume Ultra also doesn't like to mismatch maturities. It doesn't want to use notes payable, short-term funding to fund long-term projects. So to back up, Ultra will only use long-term debt and retained earnings, like most companies. So, two-step, Texas two-step. First, we determine the component cost of each source of funding. Then we take the weighted average. Ultra has consulted with its investment bankers and determined it can sell new bonds. They've advised Ultra that these bonds should have a 20-year maturity $1,000 par, a 10% annual coupon rate, and if they do that, the bonds will sell at par. So from the standpoint of Ultra, they need to earn 10%. But we're assuming we get to keep the full 1,000. And that won't be the case. When a company sells new bonds, they incur flotation costs, investment banker fees. So let's assume, I'm not going in nice order. I'll come back and get this in a second. Let's assume that Ultra, when it sells these bonds, must pay a $20 fee to investment bankers. If that's the case, they don't net 1,000, they net 980. They pay coupon interest of 100 a year, 1,000 at maturity, and these are 20-year bonds. So if we solve for I, we find the actual interest rate they're paying is 10.2%. That is known as the before tax cost of debt. R sub D. Think of R sub D like the interest rate on debt. That's what it is. But businesses get to deduct interest expense for tax purposes. So whenever they pay interest expense to a bondholder, that reduces their tax bill to the government. There are tax savings. The after-tax cost of debt can be found by taking the interest rate on the debt, which is 10.2%, times 1 minus the tax rate. Earlier, we were given Ultra's tax rate is 40%. So their after-tax cost of debt is a little over 6%. And we'll keep a running tally for Ultra here. So for Ultra, our after-tax cost of debt is what was that, guys?
6.1.
6.1?
Yeah.
Okay. Now, try this problem and see if you can get the check figures. Okay. That's what I was looking for. So what have we got for this example problem? Okay, fine. Dolby. Dolby can sell 10-year bonds with a $40 flotation fee. The bonds will pay a 7% annual coupon. So for Dolby, what do we got here? They're 10-year bonds. 7% coupon rate would be $70 a year. They mature worth $1,000. And how much will Dolby net after investment banker fees from selling these bonds? Somebody take a guess. Well, if they sell at par, but investment bankers charge them $40 a bond, they'll really only net $960. They'll get $960 now. They'll have to pay $70 a year after tax rate. Pardon me, $70 a year in coupon payments, plus $1,000 at maturity. That gives us a before tax cost of debt. Look, when I worked it and I carried it out a little bit, I got 7.585. Did anybody get that figure? All right.
I did.
Now that's the before tax cost of debt. Or another way to look at it, it's the interest rate on the debt. If you went to a bank and borrowed $960 and they made you pay back $70 a year for 10 years plus $1,000 at the end of the 10th year, what interest rate would the bank be charging you? 7.585. Now, the second half of the problem is, what's the after-tax cost? The after-tax cost of debt is the before-tax cost times 1 minus the tax rate. Why? Because interest expense is tax deductible. It creates a tax savings. So, and what was Dolby's tax bracket? 30? So the after-tax cost of debt, if, how did I do that? Get out of there. the after-tax cost of debt, I got 5.31. Did anybody get that figure? All right. For Dolby, that's the component cost of debt. That's how much it has to earn after taxes on any money it raises from selling bonds. How much it has to earn to do what? To cover the cost of the bonds to make, after we consider its tax savings, to make the interest payments on the debt. The other source of funds we're going to look at is retained earnings. A lot of people are so misunderstand where the money comes from. For corporations, collectively, about 2/3 of the money they use, that they get for expansion, comes from retained earnings. A lot of people think, oh, they're going to build a factory so they just sell a bunch of bonds and stocks. Not so. The bulk comes from retained earnings. And what we've got to figure out is what rate of return do we need to earn on the retained earnings funds? Now we use the symbol R sub S as the component cost of retained earnings, or the minimum required rate of return on retained earnings. Typically, retained earnings belong to who? The shareholders. It's part of common equity, just like their stock shares. So we need to earn a rate on retained earnings high enough to keep the shareholders happy. The logic? Again, retained earnings belongs to the common stock shareholders. It's part of equity, just like their shares are. Since it's all part of equity, it has the same risk, so it ought to have the same required return. It's really odd, but this is not theory, this is practice. When companies try to figure out the rate of return shareholders are expecting on their stock, they have to really get into the heads of the shareholders. I mean, this is not something that's in contract. We have used two models to try to figure out the rate of return that shareholders are expecting on their stock. One was the CAPM, and the other was the dividend model. So, for example, if Ultra were to use the CAPM, let's suppose the beta for Ultra is 1.4. Treasury securities are yielding 7%. The average stock, the average risk stock, stocks with a beta of 1 have a 12% required return. So according to the CAPM, what should be the required rate of return on equity for Ultra? Well, we run it through the CAPM model. There's your CAPM model. The risk-free rate which is usually the yield on Treasury securities, is 12%. The return on an average risk stock is 12, pardon me, I said that backwards. The return on Treasury securities, which is what we use for the risk-free rate, is 7. The return on an average risk stock, which is what we use for the market return, is 12. Now, since Ultra's risk, its beta, is above 1, it's above average in risk. So it's going to have a higher return than the average stock. In fact, for Ultra, the CAPM says the stockholders should require 14%. Based on the CAPM, 14% is a reasonable rate of return. So that's what we should assign as a minimum required rate of return on retained earnings. Or said differently, that's what should be the component cost of retained earnings. Well, that's the CAPM, but there was another model called the dividend model. Let's suppose we have the following information on Ultra that pertains to the dividend model. The stock is trading at 21 a share. The dividend for the year just ended was $2, and we expect dividends to grow at a 5% rate forever. If we applied the dividend model to Ultra, notice since this is the dividend for the year just ended, to get the dividend for the coming year, we increase it by the growth rate. So to get a dividend for the coming year of 210, and that's what we use in our dividend model. Dividend for the coming year over the price of the stock plus the growth rate. Since the dividend model is an algebraic time value function, all interest rates and growth rates have to go in decimal form. And the answer comes out in decimal form. So we have a dilemma. The CAPM says our stockholders should require 14. The dividend model says our stockholders should require 15. Why did the two models give us different answers for the stockholders' required rate of return on retained earnings? They're based on different assumptions. I mean, the CAPM focuses on systematic or market risk, beta. The dividend model focuses on the growth rate and dividends. So what should Ultra do? Should figure out which model it feels best fits its shareholders. Utility companies tend to use the dividend model. They're the primary dividend paying companies. A lot of other model companies will use either the CAPM or some variation of it. And by the way, earlier with debt, we found the before tax cost of debt. Then to get the after tax cost, we multiplied the before tax cost by 1 minus the tax rate. We did that with debt funding because interest expense on debt is tax deductible and produces a tax savings. Excuse me 1 second. I'm conducting a class and I'm hearing you.
Oh, sorry. I didn't
Okay.
realize.
Things are out of control. All right. Once again, back when we found the before tax cost of debt, we adjusted it by multiplying it by 1 minus the tax rate to get the after tax cost. Why? Because debt incurs interest expense. And at some point in our country's history, our government decided that interest expense should be tax deductible, should reduce a company's taxable income and its tax savings. So when you use debt funding as a business, you have tax savings. So you multiply by 1 minus the tax rate. But what about with common stock? Are dividends paid to shareholders considered a legitimate cost of doing business and therefore tax deductible? No. The rate of return that we find on retained earnings, RSBS, whether we use the CAPM or the dividend model, that's already in after-tax form. In other words, anything we provide to the shareholders has to be paid out of after-tax earnings. So we don't multiply by 1 minus the tax rate because payments to shareholders don't produce tax savings. All right. Try the following problem for Dolby. See if you can get my check figures. Let's see. Using the CAPM. What would we get? Are you guys getting 16 with a CAPM and 20 with a dividend model? Is anybody getting those figures? All right, cool.
I got them.
Cool, very good. Now, long as we're here, let's stretch this out a little bit more. You know, earlier, for Dolby, we found the cost of debt was 5.3%. Let's assume Dolby likes the CAPM. So if Dolby's capital structure is, I don't know, half debt, half equity. What is Dolby's WACC? Now keep in mind that with only two sources of funding, then the WACC becomes just the weight for debt times the after-tax cost of debt plus the weight for equity times the cost of equity. So if we're going to use the CAPM for equity, the weight for debt would be 0.5, right? times the cost of debt of 5.3%. And the weight for equity would be the other 0.5 times the cost of equity of 16%. I'm getting 10.65%. That would be Dolby's capital structure. Now, what if Dolby had the following projects? X, Y, and Z. The cost of the projects, X costs 50 mil. Y costs 80 mil. Z costs 35 mil. And the expected return on each of these projects. On X, the expected return is 9%. On Y, it's 13. And on Z, it's 10. If this were the case, what would be your decision for each project? Would you accept project X? Yes or no?
No.
No. We require at least 10.65. We expect 9. So for X, we'd reject it. It's not good enough. What about project Y?
Yes.
Yes. We expect 13. We require 10.65. So Y is good enough. We'd accept it. For project Z, we expect 10. We require 10.65. What would our decision be?
No.
No.
Reject.
We'd reject it. Z is not quite good enough. So we would only accept project Y. Notice what we do. We calculate the component cost of debt, the component cost of equity, take a weighted average, and that's the hurdle rate. That's the rate projects have to beat to be accepted. And only project Y looks good enough to be accepted. This is actually a good stopping point. Do you have any questions?
Yes, sir. But it means I've got to take you back a little. Will that be okay?
Sure.
Okay. I was trying to solve chapter 3, slide 6. The no part. I tried, but I couldn't solve it.
Enoch, what are you in now? Are you in
Yes.
chapter 10?
Chapter 3, slide 6.
Chapter 3, slide 6.
Slide.
Okay.
Yeah, slide.
I don't even know that I've got I don't even have chapter 3 pulled up.
Okay. Well,
Let me see if I've got it right here. Okay. I can't pull up the slide, but I do have the if I'm in the right spot, this is the one that starts with no pat,
yes.
is equal to EBIT times 1 minus the tax rate.
Yeah.
Was your question about the no pat or the free cash flow?
Yeah. Well, my main problem was how we got the FCF, how we got the 1455 as the operating capital for the prior year. I don't know where
Okay. Hang on
where
with
we
me.
got the 1455.
It was given. It was given.
It was given.
Yeah, I didn't put it in the slide, but when I covered it, I simply told you, it should have been. It should have been in the slide.
I said the slide. I didn't get it.
Given operating capital for the prior year, which in this case was 2019, was given as 1455 mil. I had failed to type it into the slide. So when I covered it, I simply gave you this.
Okay.
Now, go to slide 9.
Okay.
Okay. And oddly, in slide 9, I ask you to calculate the operating capital for 2019. And that is what you should have gotten.
Okay.
But in slide 6, I simply gave it to you.
Oh, okay.
Does that help?
Yeah. Yeah. Yes, Doc.
Okay, guys, before I forget, we meet Wednesday. We do not meet next Monday. If we were still meeting on campus, day classes were to be canceled the Monday after Easter. And I checked with both the registrar and my dean, and they said that the classes that used to be day classes on Monday that are now online classes like this one will not meet next Monday. So you have a little bit of a break, but we do meet this Wednesday.
Okay.
Any questions? All right, I'm going to go ahead and adjourn our meeting, and tell you what, I've got an Arnold Schwarzenegger keyboard. I have to hit it really hard for it to respond. Any questions before we quit? All right, y'all stay safe. I'll see you Wednesday.
Okay, Doc. Bye.
Bye-bye.